Why does the price of a dollar change every second? Not every day, not every hour, every second. Right now, the exchange rate between the pound and the dollar is different from what it was 30 seconds ago, by a fraction of a cent usually, sometimes much more. Nobody voted on that change. No government approved it. No single bank decided it. It happened because millions of buyers and sellers around the world adjusted their positions simultaneously in a market that never closes and never sleeps. This is the foreign exchange market. The Forex market. It is the largest financial market in the world by a significant margin. In 2022, the Bank for International Settlements estimated that roughly $6.6 trillion of currency was traded every single day. The New York Stock Exchange, often described as the center of global finance, handles around $20 billion of equities per day. The Forex market is more than 300 times larger. So who is doing all of this trading? Banks, primarily. Large commercial and investment banks buy and sell currencies constantly, both on behalf of clients and to manage their own risk positions. Central banks intervene occasionally, attempting to influence the value of their currency in one direction or the other. Investment funds move enormous sums between currencies when they make international investments and need to convert back when they exit. Corporations doing business across borders buy the currencies they need to pay suppliers in other countries and sell the currencies they receive from overseas customers. And then there are the speculators, traders who buy a currency because they believe it will rise against another and sell when they believe the opposite. All of these participants, transacting across thousands of screens at any moment of any day, are collectively setting the price. Here is what actually moves it. Interest rates. When a central bank raises its interest rate, holding money in that country's currency becomes more attractive. Investors and banks can earn more by depositing funds there. Foreign capital shifts toward the higher-yielding currency. Demand rises. The currency appreciates against others. When rates are cut, the reverse happens. Capital moves elsewhere, seeking better returns. The currency falls. This is why an announcement from the Federal Reserve, or the Bank of England, or the European Central Bank can move exchange rates within milliseconds, not because the rate changed at the announcement, but because traders everywhere adjust their positions based on what the announcement implies about the future. They are not reacting to facts. They are betting on expectations. Which is also why exchange rates can move violently on events that have nothing to do with interest rates at all. Political uncertainty unsettles investors. A surprise election result, an unexpected referendum outcome, an abrupt policy shift. These things alter expectations about future stability, future growth, future borrowing costs. Investors move capital toward currencies they consider more predictable and reliable. The Swiss franc and the Japanese yen have historically behaved as safe havens. When global uncertainty rises, both tend to strengthen even when nothing specific has happened in Switzerland or Japan. The currencies appreciate because they are considered less likely to be destabilized. Currency values are not measuring what a country's economy is worth today. They are measuring what millions of people expect it to be worth tomorrow. This logic also explains why no government, no matter how powerful, can simply declare an exchange rate and hold it indefinitely by willpower alone. Britain tried this in 1992. The pound was pegged to the German Deutschmark as part of the European exchange rate mechanism, an arrangement designed to stabilize European currencies ahead of monetary union. When speculators concluded that the rate was unsustainably high, given Britain's economic conditions, they began selling pounds in enormous quantities. The British government raised interest rates to 15% and then 17% in a single day, attempting to make the pound attractive enough to defend. It spent billions from its currency reserves buying pounds to support the price. By the evening of the 16th of September 1992, Britain withdrew from the mechanism. The pound fell sharply. The hedge fund manager George Soros, who had positioned his fund heavily on the correct prediction that Britain could not hold the peg, made an estimated £1 billion in a single day. The market had decided the official rate was wrong. No government had enough reserves to disagree indefinitely. The exchange rate is not a price anyone sets. It is a price everyone discovers, every second in real time, through billions of separate guesses about what the future holds. Now you know.